Good morning to everyone. Am I audible?
Yes, ma'am, you are audible, ma'am.
Okay.
Yes, ma'am.
Yes, you are audible, ma'am.
Okay, sir. Okay. Good morning to everyone. Esteemed speaker of today's webinar, Mr. Rameez Raza, sir, knowledgeable participants, and my colleagues from Divya Jyoti Foundation. I, Kajal Gupta, manager of Divya Jyoti Foundation, extend a warm welcome to you all in this webinar. So, today's topic of webinar is the valuation of startups. As you are aware, our speaker, Mr. C. Rameez Raza, sir, a learned and experienced professional, shall take up this session on valuation of startup. He is a fellow member of ICAI and a registered valuer. Now I hand over the proceedings to the sir. Please continue. Thank you.
Thank you, ma'am. So good morning, one and all present here. So I am Rameez Raja. So today's topic is quite interesting. It's a valuation of top startups. So let me just start with the presentation and I'll run you through. So I hope the screen is visible. So it's a pretty elaborate topic, valuation of startups. I will try to keep it as crisp as possible and cover it in the 2 hours time. And before we get started, let me introduce myself. As ma'am said, I am a chartered accountant and an IBBA registered valuer. I am from a technical background as well. I did my engineering from NIT Trichy. I am an electronics and communication engineer. Later did my MBA from finance from IIM Kozhikode, Indian Institute of Management. And later on, post MBA, I worked with Citibank, Bombay in Treasury and Trade Services Department for a couple of years before moving on to CA field. My father is a chartered accountant, so I did CA post my MBA to join his practice. So currently, I'm a practicing chartered accountant as well as registered valuer, and I am also CISA and DISA certified. So I should thank DGFRVO to give me this opportunity. It's a great topic, the startups, especially in India. At least last 2 years has not been that great because of COVID. Otherwise, startups, Bangalore and these sub startups has been blooming like anything. So it's a great opportunity for professionals like us because these are not conventional modes of valuation, right? So these are the companies where balance sheets will be hardly anything, revenue would be nil. So how do you value such a company? So that's why I chose this topic. So let's, how I'll structure this presentation is there are various types of methodologies for how start valuation has to be done, various methodologies. So I will cover all those things. And towards the end, let's keep the Q&A, okay? So it's a fairly 2 hours presentation, so we'll have plenty of time for Q&A. So don't worry, you can either use the chat window or the Q&A to post your questions. So we'll definitely address all questions. Yeah. So when we start, let's see what a startup means. So Mr. Neil, who's a co-CEO of Verby Parker, he says startup is a company working to solve a problem where solution is not obvious and success is not guaranteed. Of course, if you see the Indian startup space, I will take the big companies, say Oyo Rooms, Ola Cabs. These came in at a point when such a thing we have never thought of those things. Like I'm from Chennai, so getting an auto for me, I mean, negotiating the price is a hassle. And hiring a cab, it's for the rich people. They charge exorbitant prices. So that time when Ola came in, so I hardly stopped going in autos. I had a problem. Ola gave me a solution. So when Ola started, the solution was not obvious. Like they wanted to address it, but they don't know whether it will click or not. So that's how startups, I mean, ideate. It's based on the idea. It's not about their balance sheet, the tangible assets, fixed assets. So they have an idea to address a particular problem. So that's how they come in. The most risky part in startups is that you don't know whether success is there or not. So 1 out of 100 startups may succeed. I mean, by succeed, I mean succeed well, and 1 in a million become a unicorn company. So if you see recently, many Indian startups are also becoming unicorns. So moving on. So this is the next definition of startup, right? So this is from Investopedia, where it says startup is a company in the first stages of operations. So it has just started up. So the name itself says startup, right? It's founded by entrepreneurs who want to develop a product or service for which they believe there's a demand. Okay. These companies generally start with high costs and limited revenue. So if you see these startups, no, they have this cash burning rate. So they don't have any, the revenues will be there, but sometimes it will be limited revenue or no, no revenue, but they will have high costs. And most of the startups will be making losses only at the initial uh, period of their operations. Even if you know, like Ola, Uber have been making losses continuously. I'm not sure whether they have started making profits, but still they have huge valuations, right? Okay. So why startups is important in India? Let's see that. So if you look at the startup ecosystem in the world, India stands in the third position. So it's a huge market. We have 120 crores population, and the problems we face is, there are so many problems which the startups can address. So that's why these budding entrepreneurs now, especially engineers from IITs and even the smaller colleges, they are focusing on starting their own company rather than joining a salaried job. And look at the growth rate of startups. It's 12 to 15%. It's nothing it's fairly high compared to our GDP growth rate. And in 2018 alone, India had 50,000 startups. So out of those 50,000 startups, around 9,000, 10,000 startups are technology led. So what is easy is that when, like, for example, I just pass out of engineering. Okay. So I have fresh idea. So I don't need that much funding. So it's just a software or a code. So investments is less at the initial part. So that's why if you see there's a boom in technology led startups in India. So earlier there was this Y2K and all, like people used to go to US and all work in those software companies. But these days, most of these people feel that instead of going there, it's better like we start our own firm and all, right? And statistics says that in 2019 alone, there are 1,300 new startups were born, right? Out of implying that each day there are 2 to 3 startups that are being incorporated. And of course, everyone knows that Bangalore is the hub. So it's among the top 20 cities globally where startup for the startup ecosystem. And it is ranked as the world's 5 fastest growing startups. It's among the top 5 in terms of growth, Bangalore. So this is just for an understanding. So top 10 Indian startups as per this survey, Crunchbase in May 2020. This ranking was published by this research organization. If you see, top one is Paytm. 197 is nothing but Paytm. Followed by, one second, I'll just. So we have Paytm, Ola Cabs, Oyo, Snapdeal, Swiggy, Byju's, Big Basket, Delivery, Zomato. So if you see, I'm not sure about this one, but most of the other things are technology based, right? And app based or some software, some logic based. And look at these fancy valuations they have got. Funding, $4.4 billion, $3.8 billion, 3.2. So just for the sense of it, $1 million is approximately 6 to 7 crores. So when you say $1 billion, $1 billion would be around 7,000 crores in Indian rupees. Okay, so these are huge valuations. So Big Basket alone is like so much. So these are huge funding. So before valuing startups, as a valuer, we need to understand what stage a startup is. So startup, if you see, it has this product life cycle, right? Like the startup also has its own life cycle before it becomes a full-fledged company and starts making revenues. So we need to see at what stage the client comes to us for valuing the startup. So if you see, there is a pre-seed stage, there's a seed stage, then we have series A, series B plus, etc., etc., etc. You go to public IPO. Okay. So if you see, they define it like a plant. You nurture the plant from pre-seed to seed, and finally you tell it is harvested. Like public stage is like harvesting. So in the early stage, pre-seed stage, it's just in terms of maturity, if you see, it is just concept. I have a concept, I have an idea. So I don't know whether it will work or not. I don't know whether it's feasible or not. Technological feasibility, nothing has been done. There's no prototype. I just have an idea to put that idea and make that prototype, develop that prototype, I need funding. That is pre-seed stage. Pre-seed stage. So the seed is yet to be planted. I mean, just idea is that the plant shoot, nothing has come. Next is the seed stage, where I have the prototype or the MVP. MVP is nothing but minimal viability product. So it is one step prior to prototype. So it is not exactly a prototype, but a lighter version of a prototype. So I might not have the funds to develop a full-fledged prototype. So I'll make a small scale minimum miniature version of the prototype, which can establish my idea. So that is MVP. And also if I make the prototype, well and good, that is called seed stage. So these are early stages. Okay. For that also we need funding. So even if it is technology based also, one person would not be able to sit and write the code or develop the app fully. They might need a team who can build up the software. So funding would be required. You need an office space. There are a lot of other expenses involved, right? Electricity expenses, telephone expenses, internet charges. So funding is definitely required. And of course, to when you move from seed stage to growth stage, so seeding is done, prototype is established. Now you know that a prototype is working. There's a technological feasibility that is established by the prototype. Now you see whether this technological feasibility, is it economically feasible? One is okay, technology wise it is feasible, this is working, problem is resolved. But the revenue which you will generate, would it be more than the cost which you incur? That you need to see, economical feasibility. Then you will see product market fit. This product, here economic feasibility comes. Whether this product fits in this market and can I make revenue? And that is one thing. And scalability, when you go for series ABC, like series A, B, B plus and all, it keeps on going. So at different stages, so technological life cycle. So if you see the product life cycle, each stage you need to see what stage your startup is. So how would you diversify your product base, or how would you diversify your geographies? What target segment you are seeing? How would you scale up? So at the end of the day, any business, whether it's even CA firm, you need to see how you scale up your practice. That is anyways there, right? So even if you have a working prototype, whether if it is economical feasible, working at a scale, scaling up is pretty important. And finally comes the IPO stage, public. Company goes public, okay? Diverse revenue streams. So this is a company, Minty Mint, which has published this database based on the research. If you see, typically, this is the amount of funding in each stage. At pre-seed stage, it is less than $1 million. Less than, this is based on, this need not be, I mean, valid for in an Indian scenario. This is from a US scenario, but this is what a typical startup gets funding at different stages, right? And of course, each stage when you have funding, the promoter who starts the firm, his equity keeps getting diluted, right? The promoter needs to keep that in mind. That is critical. So we saw what a startup is and what are the stages of startup and how the ecosystem of startups in India is. So pretty much when you say that 2 to 3 startups are being incorporated in India per day, of course, the opportunity as a valuer for me is enormous, because all these startups need funding. For funding, they go to a valuer, right? So now client has come to us. Now we need to see how do we value. So we have two valuation standards. One, if I am a chartered accountant and I am from ICA RVO, ICA valuation standard should apply. ICA 103. If I am some other, I mean, some following IVS, International Valuation Standard, then IVS 105 will apply. These valuation standards tell about various valuation approaches and methods which needs to be adopted by a valuer. So there are three things: cost approach, market approach, income approach. So broadly, they have divided into three things: cost, market, income. So within these approaches, there are methods which are defined. Under cost approach, reproduction method, replacement method. Under market approach, you have market multiples method. Under income approach, you have discounted cash flow method. So these are methods which are under approaches. So typically, cost approach may not be that much useful for startups, because cost approach typically says about your balance sheet. What is the current cost? What is the net worth? From the balance sheet it derives. So mostly, so I discuss the models, there are cost approaches which we'll use, but mostly cost approach might not be suitable for valuing a startup. So if you look at the trend, people use either market approach or income approach or a hybrid model, mix of these approaches, or an approach which might not fit into one of these three also. They use such approaches. So what is market approach? Market approach is nothing but you have comparable companies, say Ola, Uber. Uber goes for funding. So you know a comparable company has got so and so funding. Uber has so much car fleet. Ola has so much car fleet. Uber is present in 20 cities. Uber is present in 50 cities. So based on these comparisons, you can get an idea about how much you can value Ola based on Uber's valuation. Just for an example, I'm telling. And income approach is obviously based on future cash flows, right? I have an idea, I have a business model. So when I put into use, obviously it should have some revenue generating capability. So once it generates revenue, you discount it and get the value. That is income approach. Fairly simple. So as a chartered accountant, like we must be clear about all these approaches. This is like basics, like how debit and credit is important, no, for a chartered accountant. In valuer, these three approaches are very critical. You need to understand. So there are customized methods, this method, that method, you have Chicago method, there are various methods. But at the end of the day, all methods to some extent fall under these approaches only. When you are clear with this, you can do any method and approach. Okay. So let's see how a CA profession is different from a valuation profession. So as a chartered accountant, I generally see accounting balance sheet. This is how an accounting balance sheet looks like. What happens? You have fixed assets. Fixed assets are recorded at original cost adjusted for depreciation. So when I'm taking the net worth of the company, no, I'm valuing. So I see fixed assets on the balance sheet. So it is at cost. So assume some companies there over a period of 5 years or 3 years, the cost would have changed. I mean, the current market value would be different from the cost. So that would not be incorporated because I'm valuing at cost. And I have investments. And you see the whether it's recorded at cost or mark to market, it depends on the motive why those investments are done. So it depends on my past decision. Like when I purchased that particular financial security, like how, I mean, what was the motive? Based on that, the accounting is being done. And intangible assets. Unfortunately, in India, like most of the balance sheets, if you see, maximum intangible asset you will see is a goodwill. You wouldn't see other intangible assets. So I mean, a company could have a brand value, could have a trademark, a patent. There are a lot of intangible assets. Some companies have, I mean, recognize it, some companies don't. But most of the time you see only goodwill. And also goodwill in, I mean, as per accounting standards, it's only, you can recognize it only if there's acquisition. You have paid money to acquire a particular concern, then the extra money you pay, that falls under goodwill. It's just a plugging figure. And of course, the liabilities, historical cost, equity, and retained earnings. This reflects past, what you have invested, and retained earnings, what you have made in the past. So if you look at the entire balance sheet, it reflects your past. What is the current status of the company based on your past? Original cost, retained earnings, investments. Okay. So as a valuer, more than an accounting balance sheet, you should look at something called as financial balance sheet. The same things, but look at it from a different perspective. See, assets in place. So existing investments record based on intrinsic value. You should see the cash flows and the risk when you value an investment, not based on how much you paid in the past. You should value it based on what is the revenue earning capacity of that particular asset and what is the risk associated with it, and not the original cost. Okay, that is which assets which is existing. And in future, based on your profits or cash flows, you invest in other assets, growth assets, expected value from future investments. How much these assets will bring in the future, that needs to be considered. This is assets. In liability side, when you see, there are two things, debt and equity. Of course, debt in future, what debt will be taking, current debt also I need to consider, what are the future cash flows because of that particular debt. Of course, there's no role in management because debt is, I mean, it's not equity. And in equity side, what you need to see, role of management. So Of course, if you take a company like Reliance, okay, when Dhirubhai Ambani divided, after Dhirubhai Ambani, Mukesh and Anil Ambani took Reliance different areas. So Anil Ambani took telecom. We know how Reliance telecom operated under Anil Ambani. Okay, same, they had a no compete clause. So Mukesh could not start a telecom business. After that no compete clause, those 5-6 years have expired, Mukesh started Reliance Jio. So that is also telecom, this is also telecom, same father. But you know how Jio has been functioning compared to how Reliance Telecom was there under Anil Ambani. So you know what is the, of course the markets were different at that point of time, this point of time, but still there is a significant role of management. How the key managerial persons, how the promoter, how they take the company forward. So that needs to be considered. That's like an, I mean, qualitative factor for startups. That is very, very, very important. As the promoter, as the owner of the particular entity, okay, what role he plays. Sometimes if it is they call serial entrepreneurs. They start a company, they run it for a few years, they sell it, they start another company. Or for example, Flipkart, there were these founders, these Bansals, right? Sachin Bansal and Binny Bansal. So after they sold Flipkart to Flipkart, the stake they had, they started investing in other startups. So the value of the startup keeps increasing because they are the advisors for that startup where they have invested. So their professional expertise, their experience in Flipkart, that helps the new budding startups to prosper well. Their valuations also shoots up because of their role. So this is very, very critical. And of course, value depends on magnitude of growth, future cash flows, magnitude of growth, and the excess returns over investment. What you invested, based on that, what is the return you will get? Okay. So compared to a full-fledged normal company, when you see a startup, what are the parameters, what are the factors as a value I need to keep in mind? First, as I said, business stage is critical. Based on the business stage and also what type of funding they are looking at. Angel investors, venture capital funds, private equity investors, or they are going for debt funding. So you need to consider this. Also, what is the, I mean, concerns which I am having? Generally, most of the simple valuations, we either do net worth, balance sheet, we'll take assets minus liabilities, we do, or we'll do 5-year projection, do a DCF, discounted cash flow. But unfortunately, if you take startup, they will not have any track record. A couple of years back, I was there at IIT Madras attending one of these startups. They have these exhibitions, right? They showcase the startups. That time, one student, he approached me. He is like, sir, I have an idea. I am developing this particular software. I have applied for patent also. I need to value my company so that I mean, launch it and full-fledged develop it. So if you go with the traditional mindset, okay, I will do a DC 5-year projection. Projections is based on my past, right? If I have some financials, based on that, I project. There's no financials. He comes to me, I just have an idea. I have just starting coding. I have just applied for the patent. So that's a huge concern. I mean, projections is simple to say, but when you look at startups, it's very difficult. And of course, they keep burning cash. Okay, revenue will be there. Assume you are doing some projections, okay, 2 years revenue is not there. After 3rd year, the company starts making revenues. But what about the profits? With the acceptability of the product, whether it has revenue capacity. Like Ola, Uber, when they were launched, you know, the kind of pricing they kept, so competitive pricing, and the kind of incentives they gave to the drivers to acquire the market space and all, they were just burning cash. You can call it like marketing or like getting those markets. I mean, so they were just burning cash. So when profits are not there, net cash flows are not there, then if you do a DCF also, you will get negative only. When you discount negative cash flows, final value will be negative only. Then how do you do the valuation? That's a concept. Next one. Okay, cash flows, there's an issue. I do balance sheet, net worth. I'm doing a software, nothing. I don't have fixed assets. I'm sitting at my home. I'm an engineering graduate. I'm just starting my own company. So I'm using father's, I mean, the internet at home, electricity at home. There's no rental, just I'm using my personal laptop. I want to value that company. no fixed assets. So net asset method, NAM, difficult. Quality of management. When you have a product, when you are valuing the particular product or the service, you know how much revenue potential that could have, how much revenue it could fetch. But when you are assessing the management, the promoters, you know that the promoters will have a value. So assume I have a company and Mukesh Ambani is sitting on the board of directors of the company. Of course, the value of the company shoots up because of Mukesh Ambani sitting as the director of my company. But when I put a value to Mukesh Ambani, how do I value it? That's very qualitative, right? That's a concern. You know that it has a value, but as a value, I struggle to put a value. Business model, of course, it's each startup has its own business model, a different idea, out of the box concepts, proof of concepts. Whether it's each, like if you see the statistics, most startups fail, unfortunately. But when you speak to the promoter, they are so passionate. They say, no, this is technological feasibility is there, economic feasibility is there. But as a valuer, when I am valuing, I need to have some technical knowledge also to some extent, so that I can assess whether the projections he is giving, whether the estimates for economic feasibility he is giving, it's correct or not, or else the valuation goes for the toss. If you just rely on whatever the management, the promoter says, right? Because he will be so passionate about that idea. He will say that I will make so and so revenue in so and so years, but that need not be the practicality. He will have that bias because it's his baby, right? That's what I said, technology and commercial feasibility. Next is scalability. This is critical. Okay, got it. Commercial feasibility is there, but how do you scale up? Revenues will be flat, right? Even if you are commercially feasible, you need to scale up. Either you expand your geography, or you expand your market segments. So 18 plus, 40 plus, some, I mean, particular market target segments which you have. How do you scale it up? So that needs to be considered when you are valuing a particular company. And most startups use this valuation multiples. You have these PE multiple, EV by EBITDA, EV by sales. There are various multiples, right? Likewise, in startups, there are synthetic valuation multiples. So when profits are itself negative, companies making losses, then PE ratio and all, I mean, it will not be that appropriate. So that time you need to get synthetic valuation multiples, which are appropriate for that particular startup. So these are certain, I mean, key focus areas, or the, I might say, concerns or special areas to focus upon as a valuer when I'm valuing a particular startup. Okay, so let me, before I get into the valuation methods, let me just tell about WhatsApp. Okay, so now we might not call it as a startup, but when Facebook acquired it in 2014, it had only 55 employees. Okay, so in 2009, two employees resigned from Yahoo and started WhatsApp. Trivia says that these who started Facebook, who started WhatsApp, they applied for a job in Facebook and they did not get it. And finally, they started WhatsApp, and Facebook acquired that company for $19 billion. So as I said, $1 billion is around 7,000 crores. So you can see $19 billion, what is the worth? Okay. So 55 employees sitting in a small office space, they made a software, WhatsApp, which most of us use. They sold it in 5 years time for $19 billion. Why? Let's see how this valuation was done and how this valuation is different from how you value a normal company. So in 2014, WhatsApp had 450 million monthly users. And it's not that monthly users, I mean, I just register, I don't use it. Not like that. Out of 450 million, 72% use it daily for our active users. Okay. And if you look at the trend, the user base grew faster than any company in the history, global history. No company got 450 million users in 5 years. So in 2014, if you compared WhatsApp with other companies, Facebook had only 145, that is almost 1/5. Gmail 123 million, Twitter 54 million, Skype 52 million. So WhatsApp was not at all comparable with other companies. Okay. And they had a volume of 19 billion messages being sent and 34 billion messages being received each day. And the messaging volume was almost reaching the SMS volume, global SMS volume. So this was computing with the SMS. Even now, like if you see like most of the messages which we do these days, hardly anyone uses SMS. Mostly people use WhatsApp messages. That's how WhatsApp has become a significant part of our lives. So this is all the features what WhatsApp has achieved. But why $19 billion? Is it because of its assets? Is it because of its revenue? Let's see. So as the famous saying goes, you are worth what they will pay for your company. So 55 employees, they never knew their worth was $19 billion. When Facebook paid $19 billion, oh, wow. So WhatsApp is worth $19 billion. That's how it went. So let's see what their assets and revenues look like. So this is the profit and loss statement in 2012 and 2013. Okay, year ended. This is in thousands. So it was making a net loss of how much? $138 million in 2013. So it's not a profit making company when WhatsApp was acquired by Facebook. Okay, next. Okay, whether the balance sheet was big, look at the balance sheet. Total assets hardly 50 million, liability 60 million. So of course, because of loss and all, they had a negative this thing, but still, even balance sheet, of course, the technology company, you cannot have a huge balance sheet and all, right? So it was not there. So why $19 billion? Here lies the answer. Look at the trend. I gave these numbers, but look at the growth rate of WhatsApp, number of users compared to Facebook, Gmail, Twitter, and Skype. This is a huge number. So, of course, the actual methodology which Facebook used to value WhatsApp was not out, but mostly they used a hybrid model, and it was based on market multiples. So during that time, Facebook had acquired Instagram. They were also in talks in acquiring Snapchat, and Yahoo had acquired Tumblr, and there were comparables, right? Microsoft acquired LinkedIn. So there were a lot of these tech companies with user bases. So if you look at those user bases and compare to WhatsApp user bases, you can have, they had a market multiple. And also Facebook would have considered the synergy. Now, if you see, Facebook is trying to integrate WhatsApp, Instagram, Facebook. From Facebook, you can post into Instagram. From Instagram, you can post in Facebook. Likewise, he's integrating WhatsApp and Facebook, and WhatsApp business has been launched. So all these things were kept into mind, these synergy and future potential for WhatsApp. These things were considered while arriving at this $19 billion for WhatsApp. Okay, so startups can be considered as a magical box. So you don't know how it works, and it is very tricky. It's a new concept. Now, how do I value this box? So all these examples, I will be considering startup as a box. So this particular startup box has various parameters. So you just slice it out into various particular things, and then you value it. So a startup could have a patent. It would have management. It would have a own developed software. It would have an idea. Okay, it will have various components, right? So each component needs to be valued, and when you add everything, the value of the box, the value of startup comes up. That is one thing. I mean, these are the fundamentals for the various approaches which I'll be covering, because breaking the startup into silos, each parameter which helps in generating revenues. Of course, there's a patent, the role of management, such things, which helps the startup. Assume you put $1, it will make $3. So this is a revenue earning capacity. When you invest $1, you make $3. When you invest 1 million, you make 3 million. So that's how you do those projections, or you value a startup, right? It should have that revenue earning capacity. Okay. So now the actual presentation starts, right? So let's focus. So we have predominantly 9 valuation methods which are focused only on startups. Some of these you might have already seen: discounted cash flow, book value, liquidation value, comparable transactions. These might be familiar to existing valuers, but Berker's method, risk factor summation, scorecard method, first Chicago method, venture capital method.
Sir, you continue.
Yeah. Okay. I thought someone was asking question, but if you have any question, you can post in the chat, or we will take it up at the end. Not an issue. And please stay on mute. Okay. Continuing with the valuation methods, as I said, these four are, people may be aware of these four methods. What are new is the Berkus method, risk factor summation method, scorecard method, first Chicago method, venture capital method. So let's see how each method works. So Berkus method, it is just like a rule of a thumb. It is, I mean, not that scientific, but it is based on 5 key success factors. And you have this risk factor summation method. There are various risk factors. So in this method, they have arrived at 12 risk factors, okay? 12 standard risk factors, and valuation is based on that. Scorecard method is somewhat similar to this factor method, somewhat similar to this method. Both are almost similar. And these things I will not touch upon now, because these are fairly simple. While discussing in detail, I will touch upon it. First Chicago method is based on various scenarios. I request participants to stay on mute. 1 second. Okay, good. So first Chicago method, venture capital method. Okay, let's move on. Okay, here goes Berkus method. So Dave Berkus is a renowned author and an angel investor. So what he said that pre-revenue, I do not trust projections, even discounted projections. So in startups, you have this fundamental concept of pre-revenue, post-revenue. Pre-revenue is when you are in the conceptual stage, a prototype stage, you are yet to start making revenue. Post-revenue is when you start making revenues. So at pre-revenue stage, when you do some projections, he says it cannot be relied. Why? Because as an investor, he had seen past firms, past startups who have given. So his analysis says that 1 in 1,000 startups hardly meet or exceed the projected revenues. So of course, as practicing chartered accountants, you must have seen when clients come to us, when they want to go to a banker for a loan, they will say, sir, boost up the revenue, make a big balance sheet, increase my revenue so that I will get higher loan. At the same time, when they come for tax filing, they will say, sir, why to pay this much tax, reduce the revenue, increase the expenses. So we have seen all these things, no? So obviously, when a founder, he goes to an investor for funding, he will try to boost up his revenue potential. He will say this has, even though he might be aware that it has 5% growth rate, he will say, no, my idea has 10% growth rate. I will achieve so and so revenue. So that's why he feels that Berkus feels that these projections cannot be trusted. He does not trust projections. That is the fundamental behind his method. So what did he do? So most of these methods which I showed, no, these are methods adopted by mostly investors or these venture capitalist firms when they were doing valuation for their clients or for their investment purposes. So they had this practical problem, and to meet those practical problems, they came up with these valuation methodologies. So when he did not have these, trust these projections, how will he go forward? So this is how he did. So this is a method of rule of the thumb. So whenever you say rule of the thumb, it is not scientific. So just to explain what rule of the thumb means, assume you have, people advise you to take a life insurance cover. So you don't know how much cover you have to take. So people say, assume your annual income is 10 lakhs, take 10x, 10 times, so you take a cover of 1 crore. So this is called rule of the thumb. Is there a scientific, this thing? Like, not exactly, but still it's rule of the thumb. So based on those, in 1990s, this Berkus method came, okay? It has gone, there were several iterations, several modifications which happened to this method later. But in 1990s, this was the, was the origination. He believed that a startup, if it has to reach a target revenue of $20 million by 5th year of business, okay, if you believe that the startup can achieve this, and there are 5 key criteria for building the boxes, like success factors. Okay, obviously, like management will be there, product will be there. There are some factors which will make that revenue, make that startup earn revenue, right? Likewise, in his model, there are 5 key criteria for that box for the generating the $20 million revenue. And each criteria, he gave a value of $500,000. 0 to 500, you can rank it based on how much you feel you can put an value. So if you value, the company will either become 2 million or 2.5 million. I will explain this particular point in the next slide. So he says that startups have extreme risks, and that's why you should value it very low. Keep a value low enough because it is very risky. So it is very conservative type of value. So as I said, he's an angel investor. So he is not a founder of a startup. He's an investor. From his perspective, even though if a startup has huge revenue earning capacity, he will try to play down and invest less money because he knows that it is very risky. So most of the startups where he invests will fail. So he will try to play down or bring down the value. That's how he says. Must be kept low enough. Startup valuations must be kept low enough to allow for extreme risk taken by the investor and to provide some opportunity for investment to achieve. So only then, as an investor, I will have a time frame, right? I will be put for 10 years, 15 years. After that, I will exit. So only if you invest less and the company grows, you can sell it off at a huge percentage and move on. And this 10 times increase also, this should factor in the failures of the investor in other companies. I invest in 10 companies, 10 startups, 9 will fail, 1 will succeed. This 1 has to give me money, and this 1 has to compensate the losses of the remaining 9 also. So as a valuer, when I'm valuing, so there are some valuation standards. You will say, no, basis of value, premise of value, what is the scope, why I am doing this valuation, for what purpose. So you need to see whether the investor has come to me for valuation or the promoter has come to me for valuation. That is very critical. So the valuation will depend. Obviously, when you are valuing a company also, no, you will see whether you are valuing the market value or the liquidation value. There are various parameters like that, right? So it's like that. And once a company is in revenues for the period of time, so this is for early period startups. So you have not started making revenue. Once the company has started making revenue for a period of time, this method is no longer applicable. Okay, Berker's method is only for mostly pre-revenue startups or just started to make revenue. Okay, so as I said, this particular point, right, I will explain here. So this is what the 5 success factors which Berker's feels will help this particular startup achieve at least 20 million revenue in year 5. So each particular factor 500,000. Okay, 0 to 500,000, you can put a value. So as a valuer or as a promoter, when I am seeing this, so what is the idea? Whether it's a sound idea, it has a potential or not. I put a value from 0 to 500. I put a value 300,000. Next, the prototype, the technological feasibility based on the prototype. Okay, I put a value. There could be an idea, but prototype is yet to be made. That time this will become 0. Here prototype is there, it is working. I put this value. Next, quality management. Okay, this particular person has done XYZ things in the past. I know he can execute. I know that value. Based on that, I put here some value 0 to 500. Strategic relationships. When you go to the market, no, you need buyers. You need to collaborate with a lot of people. That particular capability, you put a value. So maximum value which you can achieve for these 4 things is $2 million. Okay, $2 million. Why? Because each one maximum value you can give $500,000, 500, 500, 500, 500, 2,000. So $2 million. It is post. There are 2 things. Okay, this is pre-sales 4. This is post rollout or sales. So this is before generating revenue. So before generating the pre-sales, maximum value as per Berker's method could be 2 million. Post here 500,000 you can add it. So maximum is pre-sales is 2 million. So when you If you go for post revenue or post rollout or sales, 2.5 million. So that's how. And what is tricky here is, if you look at valuation standards, right, they tell a valuer, you must consider various parameters. You must ensure that you see market, business, promoters, etc., etc., etc. But never it says or instructs me how to arrive at that value, how to determine. So now you know that I have to put a value for sound idea prototype, but valuation standards will not tell me how to put that value 300,000. As a professional, I have to use my professional judgment to arrive at this value based on various parameters. It could be comparable companies. It could be based on my past experience. It could be based on revenue potential, XYZ parameters. And I should be able to justify that. Okay. Okay. Moving on to the next method, risk factor summation method. RFS, risk factor summation method. So this is the second methodology which we are seeing. This is developed by Ohio Tech Angels. That is also, name itself says it's an angel investing company. So what does this method says? Reflecting the premise that higher the number of risk factors, higher the number of risk factors, higher the overall risk. So if risk factors are more, risk will be more. This method forces investors to think about various types of risks which a particular venture must manage in order to achieve a lucrative exit. You saw this term, lucrative exit. So obviously, when Ohio Tech Angels came up with this, they are angel investing company. So they are looking at investing and exiting whenever they make. So when I'm investing, I go and see the venture. Okay, first thing I see the venture. Second thing, I will do various types of risk that particular venture has. And now, number of risk factors and what is the overall risk. So these parameters I will see. Based on that, I value a company. If risk is very high, no, I will give less money so that even if it fails, my loss will be less. So risk return, risk reward benefits, no. So if risk is less, if risk is more, I pay less so that I get a huge return because chances of failure is more. That's how this methodology came in Ohio Tech Angels. So let's see like how the summation method is being done. Okay. So as I said, it is called RFS method. So compared to Berker's, at least this is a little more scientific, evolved version. Berker's method had only 5. Berker's method, rule of the thumb, it had 5. Whereas RFS method had 12. Here it is 5 success factors. Here it is 5 risk factors. It's 12 risk factors. Okay. And how do you manage those risks? And Berker's method, you had used $500,000 for each parameter, 0 to 500, right? 0 to 500. Here it is 500 to minus 500. If it is low risk, you put 500,000. For very high risk, you put minus 500,000. And it is in multiples of $250,000. When you put a factor for a value for each factor, no, this is the scale which you use in risk factor summation method. And obviously, as I said in Berker's method, no, putting a value for each factor is the key thing here. Otherwise, this is a fairly simple model. And so here we go. These are the 12 factors. So management risk. So the promoters, they are very established. They have future. They have other startups which have worked well, and so it's very low risk. Assume you have a startup where the founders are very, even though they are experienced, they're very old, 80 plus years old. There's a management risk because what happens suddenly if the founders die. Okay, such parameters are. So all these factors, one, capability of the management, age of the management, continuity is very important in startups because the whole idea lies on how the particular promoters run the show. Okay, startups, it is very critical because it is mostly promoter driven. So management risk is very critical. If it is low, you put plus 500,000. If it is very high, you put minus $500,000. Okay. So next parameter, it is stage of business. So of course, when you have a stage, it's initial pre-seed stage or prototype is yet to be made. of course the risk is higher. If you have a prototype, you have established it, technical feasibility is done, economic feasibility is done, and obviously the risk is lesser, because as an investor, when I'm going, I know that the prototype is there, I know it is working, I know it is scalable. So the company has tested this particular product in, say, one city, Bombay. It has already tested in a particular area, Thane. Okay, that is done. Now my reliability on that particular business is higher. Compare it with another startup which is yet to make a prototype itself. They just have an idea, I have this idea, I will do this, I will do that. Sab hawa mein hai, so it's in the air, so you don't know what value to put there, right? It's highly risky. That is the second one, stage of business. Third one, legislation and political risk. Of course, in a country like India, this is very important. So Tata Nano, such a great idea Ratan Tata had, right? Car for the common man, 1 lakh rupees nano car. They went to West Bengal, they invested everything and they started the plant. And what happened? Because of, obviously, farmer protest was there. Unfortunately, I don't know whether it's farmer protest or nothing, it had a political motive or whatever, and they had to come back from West Bengal. So that's a political risk involved. You need to see whether such parameters are there, right? That needs to be considered. Manufacturing risk. So assume it's a manufacturing concern. So I'm a, say, electronics company. So I'm to manufacture those chip boards and all. So manufacturing facilities are there in India or not? I need to import certain raw materials. For importing those silicon chips and ICs and those things, maybe from China and all. I need to consider whether some import ban might come, or import duty could be there, or manufacturing, some labor issues can come. So all these parameters needs to be considered. Okay. Sales and manufacturing. Manufacturing is a repetition. This is mostly a sales risk. So after the prototype stage, while selling, what are the hurdles I will face? Whether it's easy to generate revenue or not, those things. Of course, funding and capital raising risk. So even though your idea is very strong, right? Funding is a tricky thing. So the markets behave randomly. So we are in COVID second wave right now. We were in COVID first wave last year, same point of time. On the number of cases, the scenario is pretty bad now. But look at the market, Sensex. Sensex hit a dip in March last year. Now it is more than 45,000, 48,000, 50,000 and all it is touching. So markets is a tricky thing. So when you go as a startup, when I'm raising, one, your idea should be good. Two, the market should be good. The funding, the investor sentiment should be there. Okay. And here I would like to tell an example about Taxi for Sure, TFS. I'm not sure how many of you heard about this. So when Ola, Uber and all came, there was this company called Taxi for Sure, which was also a similar company like Ola, Uber. So they were doing pretty good. So they wanted funding. They were running out of cash. These investors were in US. They had a series of investor meetings lined up. Okay, they were, next day was the meeting. And the night before that, in India, the news about Delhi, there was a case of Uber driving rape case, news came up. That's it, gone. So a negative sentiment about these cab businesses came because of that one news that came in. And the next day, all the meetings were cancelled. Even though the idea is great, even though Ola, Uber is doing good, because on that night, that news came, next day, the sentiment was bad. So they didn't have money. They had to come back empty-handed. That's the reason Ola acquired TFS. Taxi for Sure did not have money to run more than 2 months. So they have to forcefully sell it to Ola. So this is a very, very critical risk for startups, funding. Because most startups, they get acquired or they shut because they run out of cash. So startups have these terms, as I said, cash burning rate, or they have that I have funding, I have cash enough for the next 2 months, 3 months. They don't have a long-term cash. And of course, competition risk. So you might start a company and suddenly some big venture, Tata invests in some other startups, that company will overtake your company. Those risks is always there. Of course, technology, this technological obsolescence. You come up with a technology and suddenly some other startup comes with a better technology, cheaper technology. Your company goes for a toss. Litigation risk. You can see not even startups, even companies like this Apple, Microsoft, Samsung, They keep fighting day in and day out, patent infringement. They have copied my idea. There are a lot of litigation risk. So if your company is very small, no, you will not have this litigation risk. Only when you start making money or when you are getting, I mean, prominent zone when you arrive, no, only then people will start filing cases. He has copied me. This is my idea. This, that. So that is important. On international risk, of course, when you have a company, you are looking at different markets. You need to consider what are the risk factors you will have in those countries. Okay. Of course, the reputation risk and the exit risk. So each and every parameter from minus 500 to plus $500,000, you put a value. So quantitatively, you arrive at a base value for that particular company. So assume that is $1.5 million based on revenue projections or market multiples quantitatively. These are qualitative factors for which I put a value, this range based on risk factor. So qualitative numbers, qualitative risk factors, I put a number and then I sum it up, I arrive at a value. This is the risk factor summation method. Okay, fairly simple. Okay. So of course, I can question, right? Why do you take only those 12 parameters? My startup few parameters will not apply. My startup some other parameter will apply. Okay, feel free to use whatever method suits you. Risk factor summation method on Ohio Tech Angels did. They felt these 12 factors will be suitable for the companies they are valuing. So now Bill Payne method, there is a person called Bill Payne. So he came up with 1, 2, 3, 4, 5, 6 parameters, 6 criteria. And there's a scorecard valuation method. There's another method similar to RFS method, but here the risk factor itself, they do a weighted average. I will tell you how. So RFS method, scorecard method, bill pay method, almost similar, but there are slight variations. Okay. Here goes scorecard method. So scorecard method uses 4 parameters. So it's like a financial scorecard or something you have for a particular startup. How do you value the particular startup? One, team capacity. If you see all the methods which I have been using, no, the critical factor is coming team, team, team. So the promoter is very, very important in startups, and the team is also important. Product and technological readiness, market size, and competition. So when I'm valuing a particular startup, I see, okay, this particular startup I think will work well, mostly because of team. So I put a 40% weightage to the team. And obviously for the technology is also very critical, 30%. Likewise, each company when I am valuing, each startup I am valuing, I put these weights based on my judgment of what parameter will be more critical for the success of that particular startup. Okay, so weights is the first thing which I have to do in this method. Second, versus average. So now I have put weight. I said 40% is the contribution of team capacity to my company startup. Now I will weigh compared to the comparable companies. How is my team compared to the competition? So I put 125%. So I have a good promoter, good knowledgeable, good qualified, good, he has good execution capacity. So I use 125%. Product readiness 100%. Market size very small, so I put a very small value. So I am focusing a very small area, so my value would be less because I am catering to a small area. And competition, I feel it is less. Okay, so I put these compared figures. So now I do a weighted average, 40 into 125, 30% of 100, 20% of 15, 10% of 75. I arrive at 117.5% is the multiplier. So based on this, I arrive at a weighted average of 117.5. Okay. So as RFS method also, I had this initial value, right? Initial value based on whatever method I use. And then that is for the quantitative value. And qualitative value, how risk factor summation, I had those 12 parameters. No, here there are 4 parameters. I come up with this multiplier here. In this factor, you put a value itself, but here's a multiplier. So 1.5 million into 117.5, I arrive at 1.76250 value. So this is scorecard method. Okay. Bill Payne method. So he is Mr. Bill Payne. He is also an investor as well, an author. So like risk factor summation method, where you had minus 500,000 to plus 500,000, you are putting a value, no? Here you will be putting a value from 0.5 to 1.5. 1 is the base. So here I put a rating. Like how we had weights in the previous method. Each weight I was putting a weight, no? Look at this weight, I was putting 40, 20, 30. Same thing here, I'll be putting weight. In Bill Payne method, he used 6 criteria. And in fact, they could be, you can customize it. Even 7th criteria, you can have your own criteria based on the scenario. Here also management is important. Opportunity, products and technology, competitive environment, marketing and sales channels, partnerships, need for additional funding, others. So these are the weights which I feel are critical for the success of this particular entity of this startup. And I put a rating. How I put a rating here in terms of percentages? Here I put a rating from 0.5 to 1.5. And when I multiply these two things, right, I arrive at the weighted average. Fair enough. So all these weighted averages I add. So say this is the base price, base intrinsic value of that particular startup. Now I multiply by, sorry, this is the base price of the particular startup. I get this weighted average here. I multiply it. I arrive at the value. So in the past 3 methods, what we have seen is you arrive at a base value and then you do these adjustments for these parameters so that you arrive at the value of the startups. Okay. And one thing we need to consider here is that these are models used by these famous people for their case base. So as valuers, you are free to adopt or modify these values. Like for example, Berker's method, he told $2 million. He told $20 million. In your scenario, it could be more. This could be 40 million. This could be 4 million. Okay, you can scale it up. He had used 5. You can put some other parameters instead of these 4. Okay, it will be modified. Even as I said, Berker's method from 1990, it has been modified multiple times. So these are all like, as the market changes, obviously your valuation, you need to evolve yourself. You need to change. Okay, moving on. Okay. So complicated methods are done. This is fairly simple. Comparable transaction method. I'm sure most of you would be knowing what comparable transaction method is, but for the sake of people who might not be aware of it, let me cover this. This is also called market multiple method. Why? Because from market, you will take comparable companies. I don't know. For me, Ola and Uber is a famous example. So most of these, I keep referring to these two companies. So in the market, you see one company, based on that you value another company. Obviously, pre and post revenue startups. So when you are comparing companies, so when you are comparing pre-revenue startups, it's better you take comparables in pre-revenue stage. If you are valuing post-revenue startup, it's better you take companies from post-revenue stage. Okay. And in startups, it's very difficult in getting comparable companies because as I said in the first definition of startup, right? Startup, what is a startup? Startup is something which aims to solve a problem, bring an out of the box solution. So when such an idea is coming, most of the cases, it would be a new idea, new concept. That time it's hard for you to say, okay, get a comparable company. So that is one critical, drawback to use this method for startups. But of course, if you have a comparable company, fair enough. So as I said, when you are valuing WhatsApp, right? Of course, there were like other messaging platforms, but apple to apple comparison was not there. You had to base your valuation based on, say, LinkedIn or Instagram, based on the number of users they were using. Okay. Now, when I said you use comparable, no, Uber, Ola, what is the comparable I will use? Let's see. So while choosing this comparable company, what are the parameters I need to keep in mind? One, it should have happened in recent history. So assume I'm doing an valuation now at this point of time. I cannot take one comparable which has happened 10 years back because market scenarios, fairly different. Investor sentiment is different. COVID scenario is different. So various factors are there. So it's better how closely recently you are able to take, that is better. And of course, if it is similar industry, best. And when you're screening the comparable companies, you see industry classification. Okay, type of company, public or private company. So assume I'm valuing a private limited company. I am taking a comparable public limited company. That value I cannot put for private limited company, right? Why? Why can't I use? Because when you are valuing a private limited company, it's closely held. They will have issues. Okay, public limit, I mean, liquidity problem will be there. If I invest in a private limited company, exit problem will be there, marketability problem will be there. That will not be there in the case of public limited company. Okay, financial metrics. Okay, revenue, EBITDA, net income. These are metrics which you use. But however, startups, most of the case, netting, okay, revenue could be there. If pre-revenue stage, the revenue will not be there. Then comparing will be difficult, loss making or zero revenue. Net income, what if it's a loss making startup, you have to start making profits? That's a concern. Geography, geography is important. Assume a company is in, startup is based out of Bombay. Same idea, someone launches the same thing in, say, Assam. There'll be a difference, right? The kind of the spending capability of consumers in Bombay would be fairly different from someone in Assam. So those parameters will be there. So you need to consider when you are comparing companies, it's better you take similar geographies, similar revenue mix, similar customer mix. Okay, company size, revenue, employee, locations. Of course, when you are valuing say one company having 10 employees, small startup, you cannot use a comparable company having 1,000 employees or 10,000 employees. And the product mix is very critical. Like if you are valuing a software company, take a comparable software company, service based SA, SaaS model, take a company providing SaaS service. And of course, type of buyers are important, because each type of buyer, they will have their own intentions. They will have like 10 years time horizon, 20 years time horizon, etc. And deal size, valuation, multiples. What is the multiple that's being paid? Okay. Okay. Let me just have some water. 1 second. Okay. So the first three multiples which I have mentioned, no, EV by EBITDA, EV by revenue, P multiple. These are like common things which we understand when we say market multiples, because most of our valuations we could have used these multiples. Unfortunately, in startup space, when you come, most of these multiples might not be relevant or might not suit. So we go for something called as synthetic multiples. So what are synthetic multiples? Assume you take an e-commerce company, Amazon, Flipkart, Snapdeal. So that time you see something called as gross merchandise value, e-commerce. So you have seen this big billion sale, so many million worth of goods were sold on these 3 days. So for them, what is important is the gross merchandise value, how much sales have happened on the particular portal. So that is the parameter. So assume I'm valuing like Flipkart is being acquired by say Walmart or some company. So they will see comparable companies which have been acquired, or which have been valued, or which have raised funds. What is the gross merchandise value of that particular e-commerce company? Based on that, they will value this company, because both the companies will be making losses. So that time you will see the gross GMV they use. For software companies, software services company, you see something called as for the monthly recurring revenue, because they will have long-term contracts with their clients. So each month, what is the recurring revenue they are getting? Those things you will see. For retail, Big Bazaar, okay, D-Mart, retail companies, what are the number of outlets they have in India? Okay, those things needs to be considered. Assume now patents file, medtech, biotech companies. Okay, let's say I am Serum Institute, I am Bharat Biotech. These pharma companies, how many patents I have filed? So of course, assume now Bharat Biotech is going for the, want to raise funds, going for valuation. At that time, they can use the value of Serum Institute. Based on, they can have these comparables if at all they have raised funds in the past, and you can compare the number of patents each company has filed, and based on that you can value. Here comes, this is WhatsApp. So WhatsApp, what parameter they could have used? Something called as weekly active users, WAU. This is one parameter. Sorry for my bad handwriting, but that's for messengers. What you say is weekly active users. So assume I'm using WhatsApp. So in this week, I use it today, tomorrow, daily. So for this WAU count, it will be counted only once. Active users, even once I use it, count comes. Not that daily I use it, it gets multiplied, not like that. So in a week, how many active users have used WhatsApp? That is the parameter they use. And in telecom, you have something called ARPU, average revenue per customer. So trend says that for postpaid customers, ARPU is far higher than prepaid customers. That's why when you are a postpaid customer, the kind of services you get are fare better. I mean, customer service, or when you go to the Airtel store, the kind of response you get for the postpaid customer, it is fairly better than a prepaid customer, because the telecom company earns more from a postpaid customer, ARPU. So, okay, we read about all the synthetic variables, comparable variables, etc., etc. But how do I value? How do I compare based on these values? So I have written here box. Box is nothing but a company. Assume I have 1 to 9 comparable companies which have been valued recently, similar market space. So what I do, two multiples examples I'm giving. It has, these companies are sold for this value. This is the revenue multiple. This is the WAU. What is WAU? Weekly active users. WAU, weekly active users. So WAU multiple. So I take a weighted average. So 957 into 3, 647 into 3.3. Likewise, I do, and then divide by total of this value. I arrive at a weighted average of 7.6. I know the revenue of this particular company, which I'm valuing is 90. So 90 into 7.6 I do, I arrive at 685. Based on revenue multiple, I arrive at this value. Based on WAU multiple, weighted average I take, I get a weighted average of 6.7. And I multiply by 1000, I get 6,736. This is the value. So you see, it is fairly wide. Where is 600? Where is 6,000? So for this is just an example. So when you are taking multiples, you have to see which multiple suits your company better. You cannot randomly use. So your choice of multiple plays a significant role in the the revenue, in the valuation you are doing. Assume I was valuing WhatsApp. WhatsApp hardly had any revenue. It was making a loss, or they were just started to charge some $1 per annum from each customer, right? So revenue was very limited. So in that scenario, you will not use revenue multiple, you use WAU multiple. Also, when you are doing this comparable methods, you should keep in mind and remove outliers. Look at this, look at the value. This looks like an outlier, right? So this looks like a huge company. So when you are valuing your company, when this particular thing is there, it could like, I mean, mask your valuation, or this could have a, when you're doing weighted average, it will have a bias and it's not comparable. So you might feel free to remove this particular company when you're doing the average, because it's an outlier. Similarly, when you are doing this particular, see, WAU multiple, look at it, 2.3, 6.4, 1.5, 0.2, all are comparable, but here you have one value 0.2. You have a value 31. These are like outliers. If you look at it, outlier at this point of at here. So this one 0.2, you can remove it. At this place 31, you can remove it. The remaining ones you can value, right? So that's what when you say comparable, because each and every number here, when you're doing a weighted average, it impacts your final number. So you need to be very clear when you select your comparables and you are doing a weighted average. Okay, moving on. Okay, book value method. So most of the chartered accountants, we are very familiar in value. Like before this IBB valuation and all came, like even we have done a lot of valuations. So many of it will be either projection based or book value based, net worth. You remove those fictitious assets like prepaid expenses or miscellaneous expenses, incorporation expenses, DTA, DTL, those things you remove it. And what are the actual assets you take, actual liabilities there in the balance sheet you take, that minus this will give you the book value method. Okay. That's how the saying goes. Forget about how magical the box is. See how much 1 pound of cardboard is worth. Nothing but in the balance sheet, 1 pound of cardboard means each and every item, what is the worth of it. That's what book value method says. So sometimes you just do a book value method. Sometimes you use a multiple of book value. You have a book value, but still you will pay a premium. You pay a multiple of book value for whatever reason. Maybe book value is based on historical cost. You want to pay a premium to it. So multiple of book value, say 1.5 times of the book value, or you want to pay a premium to book value. Say book value is $1 million. You would put a premium of 200,000. So I want to pay $1.2 million. Okay. Next is net worth. Net worth here, it focuses mostly on tangible assets, right? Because when you say book value, most of the cases you see only tangible assets are there in the book. Intangible assets, only maybe goodwill will be there, software will be there, but mostly focus is on tangible assets. So one of the reasons why this might not be that much appropriate for startups, but still this is also an accepted methodology. If you find it to be, this is always valuation assignments are the case specific. You cannot say this will fit for this company. So you need to use your professional judgment based on your experience. And mostly manufacturing and distribution companies it is used. And as I said, it is focused on tangible, whereas most startups use intangible. Here, what is important is audited financial statements are required. So assume I'm valuing a particular company based on book value method. So it's easier if I'm valuing the company on 31st March or 1st April because audited financial statements will be there. When I was doing the CA course, like these partnership problems, a partner joins the company, partner leaves the company, a lot of complicated cases will be there. I always wondered because most of the cases, partner joins the company on 1st April or partner dies on 31st March. I used to wonder why this is happening. But later realized that it's complicated when it happens between the year, right? To do those calculations. Assume here the audited financial statements, assume I'm valuing the company on 31st March or 1st April. I have the audited balance sheet. It's easier for me to do it. But if I am doing the valuation of a company, say today, 16th May valuation, I will not have an audited financial as on this particular date, right? So either I will have to ask the company to get the provisional financial statements, get it audited and signed by the auditor, or I have to do the valuation based on the provisional financials which the management gives, and the valuation report I clearly mentioned that this valuation is done based on provisional financial statements. The credibility for the report goes off because management, to boost up the value, they can fudge or they can obviously without reliability is less, right? When management gives without auditor signature, so that is a drawback or whatever concern in case of book value method. And as I said, book value can be understated, overstated. Sometimes when you have tangible assets in your balance sheet, plant and machinery, land and building, you might have to get a help of those valuers as well, land and building valuers, plant and machinery valuers, to arrive at the exact value of that particular asset. And you might have seen this example which I put here, Kingfisher. So when I said tangible assets, why I put Kingfisher is that this was an intangible asset, not in the balance sheet. But still in 2010, Grant Thornton gave a valuation. Sorry, Grant Thornton gave a valuation report of 3,400 crores just for this Kingfisher logo, the bird and this name Kingfisher. And banks gave huge loans based on value. Kingfisher, obviously, Vijay Mallya gave his own personal guarantee. Other assets were pledged, but the Kingfisher brand was also pledged. So unfortunately, when things went for the toss, the value of this went off, 3,400 crores. Obviously, even today, that brand has some value. So like even though Kingfisher beer is pretty famous, so most people prefer that. But it's definitely not worth 3,400 crores. So this brings us to one thing which I want to highlight now is that when you're doing a valuation, 3 dates are very important, not related to the status, but generally telling the valuation date, on which date I'm valuing, and the report date and appointment date. These things are very critical, right? So 3,400 crores could be valid on 2010, but today if I'm valuing the same Kingfisher brand, I might not get that value. So why I'm telling this Kingfisher example here is that when I'm doing a book value method, these things, this is 3,400 crores that company had value, which will not come out when I'm doing a book value method. So that's why for startups, this might not be that appropriate method. That's the reason why I got this Kingfisher example here. Next is liquidation value. Okay. So, okay, I told book value, no? Now, what is liquidation value? I mean, it's a similar thing, no? Many people might think. See, here you say liquidation value measures what stockholders can get out of business. Book value measures what they have put into business. So when you are doing book value method, no, you see historical cost balance sheet, whatever has been put into the business, that value is derived. Whereas liquidation value, distress sale, you are selling the company. What stockholders, like I'm shutting the company now, I just need to sell it immediately and get out. That is called liquidation value. That's why when you are doing valuations also, you need to mention whether you are valuing market value, liquidation value, book value. When you are doing bank audits also, no, land and building value valuation report, if you see, there will be like 3 values. There will be market value, realizable value, distress value, multiple values, the value I would have mentioned. So that's why this is very important when you are doing for liquidation value. Assume one startup is selling the company to another company going. That time you might see a liquidation value. Okay. Always book value mostly will be more than liquidation value. Why? Because liquidation value, there's a sense of urgency, hurry. You need to sell it off and move on. Okay. Value you get from sale would be below its book value due to adverse conditions of the sale. Okay. Because you are selling it in a hurry, there will be adverse condition. You just want to get out. You could see these banks auctioning the NPA assets, no? That time there's a distress sales, there's a liquidation value. They just want to sell off the assets, get whatever money possible and close that account. So that's liquidation value. Total worth of company's physical assets when it goes out of business or if it were to go out of business. Okay, that is liquidation value. Moving on. Okay, most people will be happy here. Some similar method, some familiar method has come. Discounted cash flow method. This is a method, right? Even before becoming a CA itself, you must have known, like SFM, financial management. During your CA course, you must have studied discounted cash flow method. Whether it's a startup or any company, the value I put for the particular asset or the entity depends on what this would fetch for me from future. So future, how much revenue I can earn, and discounted present value, because 100 rupees today is not same as 100 rupees after 10 years. So assume this particular asset generates 100 rupees after 10 years. When you're valuing the asset at this point of time, I need to discount, factor in inflation, factor in present value, the interest cost, all those parameters, arrive at this value. Okay. So each year I have these cash flows, I discount it and I arrive at discounted cash flows. This is the present value. Okay. These are the 3 steps. 1, 2, 3. One, estimating cash flows. That is very critical. You estimate revenues. While estimating revenues, what you do, you need to break it up as granular as possible. Assume I am a startup having 2 products. So I will divide into 2 products, forecast the revenue for each product. Or assume I'm a startup operating in 3 geographies. So I will bifurcate the revenue into 3 geographies and project it. So whatever bifurcation suits well for your scenario, bifurcate, make it granular as possible, and then do the projections. And when you're doing the projections, if there is a past history, well and good. So your projections should be based on that. And mostly in my experience, I have seen that startups have this huge projections. The growth rates, the company will be making a loss, but if you look at the projections, they will show 1 year loss, second, third year, huge profits they will start making. They will say the company has so and so potential, the company will do this much revenue and all. So as a valuer, you take the management's projections and then now do market research. See what is the market share, what is the market potential, see the competitors, see the technology, how it has been evolving, whether this technology will be, will make sense after 5 years down the line also, whether it will be relevant 5 years down the line. All these parameters you consider and feel free to change the projections which the management has given. So easiest thing would be to take management's projections, but as a valuer, what I do is I take management's projections, I take their views, and while doing the valuation, I put my own perspective, like based on my own research, based on my interview with the, I prepare a questionnaire, ask the management, ask the promoters, based on his inputs, based on the projections, based on market, you tweak those projections. And of course, you discount it and then you write present value. In present value, what is important is terminal value. This one is important. And of course, your discounting rate is important. So if you tweak these things slightly also, your valuation will change a lot. So unfortunately, some people use this to, generate whatever value they want, but you should not do it. You should be, try to use the best possible estimate for these values, discounting rate and terminal value. I will tell you what terminal value is. Before you move to terminal value, when I'm discounting, no, after discounting, I'm arriving at what value? Free cash flow to equity, there is one term, FCFE, free cash flow to equity, free cash flow to firm. If I'm valuing the firm as a whole, so that is like considering debt plus equity put together. So the capital structure is irrelevant, whether it has debt or not, like assuming it has no leverage also, that's free cash flow to the firm. So here, when I'm doing the discounting, I use weighted average cost of capital. I incorporate cost of equity, cost of debt, both the discounting factors. I do a weighted average, take weighted average cost of capital. If I am doing FCFE, as an equity holder, I have a value of firm, I pay out my interest payments, and residual amount what I get, what is the value, that is FCFE. So you can use any method. So even if you do both methods, no, FCFE plus whatever debt you have, if you add these two things, no, you will get FCFF. You can do it and see. So these looks like two methods. Actually, it's the same method with slight variation. What cash flows you use, what discounting rates you use are different. But at the end of the day, they should give the same value. FCFE plus debt will be FCFF. Okay, just for cross-checking purpose also, you can use this. So what is the FCFE? Cash flow from operations minus capex plus net debt issue. This is very critical. Capital asset pricing model. Okay, so cost of capital is RF plus beta into RM minus RF. Sorry, here I missed RF plus RF. Okay, risk-free rate plus beta times RM minus RF. RM minus RF is nothing but market risk premium. Return on market minus the risk-free rate, that will give market risk premium. Beta is nothing but slope. Assume you have your returns RM. So when you are looking at the returns of your particular company compared to the market, what is the sensitivity, what is the slope? Okay, assume say Reliance Industries Limited. So if market Sensex changes by 10% in 1 year, Reliance Industry stock has increased 20%. So what is beta? 20 by 10, 2 to 20 by 10, 2 is the beta. So if market changes by 1 rupee, Reliance Industry changes by 2 rupees, 2%. So this is beta. This is a sensitivity, how sensitive it is. So beta of that particular investment. So market risk premium into beta plus RF. This will give cost of equity. So mostly what we do for RF, we take 10-year government bond. What is the rate? Some proxy you will use. When you say what is the risk-free rate, it is difficult. So some proxy you will use. Some government bond, long-term bond you take that rate, that is risk-free rate. You should be, assume I'm valuing a company startup in Greece. So Greece, the sovereign debt, they have defaulted on the guarantee. Even the government has defaulted. So when you are doing a valuation in such countries, you need to consider, you cannot take the government rate there. Okay, if I'm taking government bond rate in India because central government India has not defaulted or will not default. That's my assumption. Okay. And RM, okay, market, of course, market returns I can take. Sensex data is available, Nifty data is available. I would be able to take it. Okay. And here, when I'm doing comparable, right, when I'm taking beta, we have discussed what RM, how to take RF. You have something beta, no? How do I take it? Take a comparable company. I am a particular company having in a particular segment. So I take another comparable company in the same segment. However, their level of leverage could be different. So what I do is I take that company, I do adjustments for the leverage. So this is unlevered beta or asset beta. So that particular company will have a leverage. I will unlever it. I will make it a unlevered beta. And then that unlevered beta I will take. I will do the leverage for my company. I will again calculate the levered beta here and then use it in this formula. Okay, nothing. Levered beta into 1 minus tax into D by E. Because for debt, you have this tax advantage in India, no tax deductible. That's why. And weighted average cost of capital, this is the formula. Nothing. Weighted average. Equity by total value into cost of equity, debt by total value and cost of debt. Because debt, you have the tax advantage, you put 1 minus tax rate. That's all simple. If you have preference shares also, you put one more factor. Preference shares divided by value into whatever. Okay. So this is just weighted average, simple. So I don't want to explain much detail into this formula, but just understand free cash flow to the firm means before interest. Okay. Net operating profit after tax, you add back depreciation minus capital minus change in net working capital. Okay. So this is FCFF before interest. So if you see here net operating profit, so interest will not be there. Here, if I take net income, I add back interest because net income is after interest. So I add back interest here. Okay. That's why if you look FCFF, this is cash flow from operation, debt issued. Here you have this before tax. Okay. Moving on. I told you terminal value. Okay. Each year cash flow, I have done. What is last year terminal value? That is make or break. So I cannot be doing the projection for 10 years, right? There has to be a point where I'll put a stop. I need to stop the projections and I need to calculate the terminal value. So assume 1, 2, 3, 4, 5. In 5th year, I want to determine the terminal value. And here also projection, why I do 5 years, why I do 6 years, that is also case to case. Mostly by practice, people do for 5 years. Assume there are a lot of variations. I see that there will be various market phases for that particular startup. I might as well go for the higher 8 years or maybe 3 years based on scenario. And terminal value can be found by 2 ways. Mostly people would have seen this particular formula. Okay, cash flow n plus 1th year divided by R minus G. R anyways, this is cost of capital, which we have discussed. And G is nothing but expected growth rate. Mostly what, because companies, they will have huge growth rate initially. After some 5 years or 6 years, they stabilize. It will be a constant growth rate. That is this is Gordon growth model. If you have read it, Gordon growth model. So you will have a huge growth rate and it will stabilize. That's what this is growth rate. That's what this model says. This would be a 1-stage model, or you could have a 2-stage model. It could be multi-stage model also. So assume this G is after it has stabilized. Finally, it kept growing. It has stabilized. The growth rate has stabilized. You use this formula, or there's a mix of income approach and market approach. Discounted cash flow method is income approach, but here also to calculate terminal value, I can use comparable method, market multiple. So how I will do, after 5 years, I want to exit the company. So as an investor, I'm saying, okay, if after 5 years, I want $100 million from this company. Okay, that is the exit value. I discount it for 5 years. That is the terminal value I'll get. Okay. So for the 5 years, the company generates revenues, cash flows, I discount it. 5th year, I sell the company. What is the exit value I will get? That exit value also, use on comparable method, you can find out. Okay. Okay. Almost coming towards the end. So discounted cash flow method is over. We have something called as First Chicago method. Why the name First Chicago came? Because the bank, First National Bank of Chicago, they developed this method. So it is like we must have learned about probability, right? Probability, best case scenario, worst case scenario. So here First Chicago method says there are 3 scenarios which you have to consider. Worst case scenario, where like Sensex, you will know, no? Market is bullish, market is bearish. So worst case scenario is called bearish. Okay. Normal case scenario is the base case, and best case scenario is bullish case. So 3 scenarios you do the valuation. Here they say use mostly DCF method. So discounted cash flow method, you use 3 scenarios. Each scenario put a probability or a weighted average, and then take the value. I will explain the next slide. So mostly it says use DCF. If at all DCF is not appropriate, you can go for market multiples or other methods. That's what it says. And here it is, I mean, used mostly by dynamic growth companies or post-revenue startups. Because mostly when you're using DCF, revenue would be there. So post-revenue startups or high growth companies, this method is more appropriate. That's what First Chicago Bank used for valuing their companies when they were investing. Okay. It's also used by most PE and VC investors. So how do I do this weighted average? Let's see. So there are three scenarios. Okay. 1, 2, 3. This is worst case scenario. This is base case scenario. This is best case scenario. So base case, so mostly normal scenario, I assume 70% base case will apply. However, there is a risk 20%, okay, bearish scenario can happen. And being a pessimistic, only 10% I feel it will become 300 million. Okay, so 10 million into 20%, 70 million into 70%, 300 million into 10%. I arrive at a valuation of $81 million for this company using First Chicago method. Okay. Okay. This is one of the last methods which we'll be covering today. This is venture capital method. The name itself says venture capital. So who uses this method? So this method was used by Professor Bill Salmon from Harvard Business School, 1987. See how many years old. So this is from viewpoint of investor. So this is mostly for pre and revenue startups. So how investor, when I come and invest in venture capital, so they will talk in terms of multiples. I need 10x return, 25x return. So that is the exits, their multiples they will look at. So first slide when we discussed, we saw something called a seed stage, pre-seed stage. So investors look at companies like a tree. So you plant a seed, pre-seed tree, and finally when you sell it, no, they call it harvest. The fruits come or whatever, you harvest the tree, you sell it off and move on. That's how investors look at it. So here you need to be aware of two terminologies: pre-money and post-money valuation. So I'm valuing a company, that is a pre-money valuation. Okay, I have this value, I put an investment on top of it. Pre-money value plus investment will give you post-money valuation. Okay, so when I'm doing this post-money valuation as an investor, that is nothing but terminal value divided by anticipated return on income. So I'm expecting 20% return, and I'm estimating a value I need to generate $100 million from the startup in 10 years. So I do this terminal value divided by anticipated return on investment. I arrive at post-money valuation. Okay. From post-money valuation, I remove investment. I arrive at pre-money valuation. This is the value. So here you might question, like, you haven't seen the revenue earning capacity of the company or the startup. You just said $100 million, 25% return. But unfortunately, that's how investors look at it. They say that I need so much returns, I need this much valuation, I will pay only this much. So that's how this particular valuation method is. So let's look at an example. So see, $100 million, I need a return, 20 divided by 20%. This is the ROI I'm looking at. So post-money valuation comes to 100 by 20, $5 million. So as an investor, I'm investing $1 million. So this is after $1 million I have invested, company grows. So before investing this 1 million, company is worth only $4 million pre-money valuation. And I adjust for the dilution. Because I'm investing, there will be dilution. Assume the estimated dilution is 30%. I multiply by 70%. So this is pre-money valuation adjusting for dilution. So as an investor, when I am investing, so I look at it this way and invest this much. So here what we see is anticipated exit. I need so and so money at this particular rate. So mostly venture capital in this method gives a low value, because I will put a high value here. I will have high returns. Mostly this will be low only, because people like to fund low and get huge returns, venture capitalists especially. Okay. Okay. You must be remembering. So because we have completed all the methods, let me conclude in a couple of slides and open to Q&A. So This slide I had covered in the beginning part of the presentation. Why am I putting here? So I told that IVS and ICA valuation standard says about cost approach, market approach, income approach. But what did I cover? I did a risk factor summation. I did the box approach, this approach, that approach. People might have a question. Boss, does ICA valuation standard or IVS, does it allow at all as a registered valuer? Can I use those valuation techniques? You said these valuation standards says these three approaches, but I am not able to fit it correctly into these valuation approach. Here comes the answer. So IVS 105, para 10.1. Look at it. Consideration must be given to the relevant and appropriate valuation approaches. The three approaches described and defined are the main approaches used in valuation. What is very critical here is this wording. So IVS 105 on valuation approaches and methods says that market approach, income approach, and cost approach are the main approaches used in valuation. It does not use the word are the only approaches or are the approaches. It says main approaches. So most cases people use these approaches, but you are free to use other approaches. When you see this word main, no, that means the standard itself says that the valuer can use other approaches. But practically why we don't use other approaches is that if I use a market approach or an income approach, in future, if some litigation comes or someone disputes this, it's easier for me to defend. If I use some customized approach, first Chicago method or risk factor summation method or some other new method, when I use it, when someone disputes it, I would need some strong backing. Why I used a customized hybrid approach, hybrid model. That's the only concern. Or else I'm free to use any approach. IVS has given us a free hand. Even ICA valuation standards is also on similar lines. Okay. So for the conclusion purposes, so we saw all these methods. So as a founder or as a investor, what method do I use out of these methods? Answer is simple. There is no black and white. It's a gray box. You decide on a case-to-case basis. You use a professional judgment. You understand each and every method. So when you sit with a particular client for the valuation, understand the scope, the purpose, what value they are looking at and why they want a valuation. And then you decide what method suits them. So it's always a case-to-case basis. And what is critical is you mostly might have to use a hybrid model. One model might not suit, especially for startups. You might have to use DCF plus, market multiple and a hybrid model. Use both. And in my opinion, it is mostly a guesstimate valuing a startup because many people might not know. Okay. And of course, this is critical. Valuation by startup or valuation by investor. That is very critical. Wow, whose perspective you are doing the valuation? Yeah, you need to see that. And football field chart. So one of my colleagues, she worked in JP Morgan. She told me that they use a method called football field chart. Like how you have a football field, no? You place your valuation analysis in this football field. You use multiple methods to value a particular company and you put a value. You arrive at a, like, as I told, no, different valuation methods could give different values. So you plot it on a graph and see what is the probable value. You pull it out that way and then finally arrive at a value. Yeah. So I think we are in the last 10-15 minutes. I will open the floor for questions. This is the references which I used. I would recommend Ashwath Damodaran. Like if you are into valuation field, please go to his blogs and videos. He is a professor at New York Stern University. So it's very useful. And thank you. And here's my contact details. So presentation anyways, I will share it with the organizers. In case if someone wants a presentation, feel free to drop in a line, drop in a text or an email. So let me open the Q&A now. Chats, okay. I will stop sharing. Okay. Let me start from the first. Are there any questions? Feel free to post your question in the chat box. So I'm just scrolling from the top. All good morning messages are there. Let me see if some questions are there. Okay. Berker's method, another method which is not included in any approach. So this question I have already answered. No, IBS 105. It says that income approach, cost approach, and market approach are most probable approaches that are being suggested by international valuation standard. So Berker's method will not fit into these particular approaches, but still you can use it, but you have to justify it. Okay, can we use Berker's method in valuation report prepared for statutory purposes? Also, if startup founder wants to raise money and we use Berker's method, non-statutory purpose, what would be the scenario? INR values in Indian scenarios. So as I said, no, Berker's method uses that 500, $2 million, 0 to 500 and those things. You are free to customize it for your purposes, but you have to justify it. Like obviously those are in dollars. In Indian scenario, you can use certain values and you can do it. But I feel use risk factor summation or some other method. Berker's method is more of like rule of the thumb. It's better you avoid Berker's method. And as you said, statutory purposes, certain statutory purposes, they have defined methods. So assume Income Tax Act, if one such statutory purpose, I'm doing a valuation, rule 11 UA you have. They specifically, they have mentioned, you use this method, you use a merchant banker would be doing a DCF under rule 11 UA. Income tax as a chartered accountant will be using book value method, net asset method under 11 UA. So if you're doing statutory purpose, see whether the statute has a rule and the method is already prescribed there. If it is not used, you can use, but I would not recommend Berker's method. Try to use some other method. Okay. Moving on. How is the base value arrived in the methods discussed? So a startup has both qualitative factors, quantitative factors. So most of these risk factors are like qualitative factors where weightages were arrived, were put in, and various percentages were put. But the base value, you stick to your DCF approach or market multiple approach. So any method you can use. You arrive at a base value based on the methods and approaches which you know, which you are not able to quantify. For that, you use the other things like risk factor summation and other methods. So normal valuation method, like how you will do for a normal company, do it and arrive at the base value. Other qualitative factors which we have not been able to incorporate in your base value, you use this risk factor summation, bill paying method and other things. Okay. Okay, base value already done. Share the PPT definitely. Instead of posting your email IDs here, like I showed my email ID, yes.rameez.raj@gmail.com. Drop in a line or send me a text. I will send it across. Thanks a lot. Okay, thank you. Okay, how do you determine a beta for a private limited company engaged in, say, textile sector? So one thing is that you can take a comparable company in textile industry, say a public limited company, you will have market data, arrive at its beta. You can do levering, unlevering. I told you, because the leverages will be different, and you adjust for the size also. You can do that. And one more database which most valuers in India use is the Ashwath Damodaran's based on previous analysis for each market, for each industry. He has published asset beta, equity beta and all. You can have a look at it also. Like either you can use those values or you can arrive at values based on market data. Take a public limited company, unlever that beta and you can use it. And DCF, one more thing which you need to consider is when you are arriving at these weighted average cost of capital and those things, there is one adjustment which people do is DLOC, DLOM, degree for lack of marketability, degree for lack of control. So when you are looking at private limited companies or the closely held companies, you need to adjust for those factors also. This and marketability will be less in those companies. There will be a lack of control also needs to be factored. So those adjustments also needs to be made. And we also looked at capital asset pricing model, where then RF plus beta into RM minus RF. You can add other risk factors also, not necessarily only that. So there are various modifications which happen to capital asset pricing model also. So if you have some other risk which is you want to factor in the discounting factor, you can feel free to add that particular risk also. There are customized models. Defending football method would be easier. It seems more scientific and reasonable. Of course. Football model like JP Morgan uses it. So it's scientific and they have been using it over the years. Any software available for income tax purposes? These days, I am getting many emails about these softwares for valuations and all. But unfortunately, especially for startups and all, like each method is customized. So it's difficult to have a particular valuation. Like there are many softwares available online, but they can only give you a base. I mean, some for DCF they will give, not for market methods and all. Projections and all softwares are available. Drop in a line. I can share some links for you. If I don't want to mention it here, it will be like marketing. So feel free to drop in a line. I will suggest valuation softwares. But finally, after using the software also, you might have to do some customizations. They will give you base models, but obviously, you know, when you're doing projections, there are various adjustments and all you will do. No, those things have to be done. How do we find beta for startups as comparables? Yeah, that is a challenge. Beta is a challenge. So that's why sometimes you go for the market multiples. Whenever there's a challenge, no, comparable companies are not there, you go for income approach. I mean, it's vice versa. So it's always challenging. And why should the valuer may provide a different valuation of a startup, whether the request is coming from company or from investor? They may have different expectation, but the value should not be different, I suppose. Exactly, when you are doing a valuation, no, obviously your point is right. You will be valuing the intrinsic value of that company, what is the revenue earning capacity of that company and all. But the purpose is different, no? Here, when you are valuing a startup, it is not for the statutory purpose. So client is asking you the particular values. He will look at from a optimistic or a pessimistic scenario. Like for example, first Chicago method I used, best case, worst case, low case. Obviously, those cases perceptions for the investor would be different. For the investor would be putting more weightage for the pessimistic percentage in that for Chicago, these scenarios which I used, no, best worst case. If I am a founder of that particular startup, obviously best case scenario, I'll be putting a higher value. So the value of the company gets changed because of those perceptions. Of course, when I am doing the valuation of a company for some statutory purposes, then it's different. But here, most of the cases, when I go for valuation of startups and all, they go for fundraising. It's not for statutory purposes. They want a valuer's justification for the value of the company, right? And okay. Mostly people have been asking for presentation. I will just post my email ID here. 1 second, you can drop in a line. This is my email ID. So you can feel free to drop in a line if you have any questions and all. So let me take a couple of questions and close it. It's already 12 o'clock. I don't want you be between your lunch and 1 second. The companies during pre-seed valuation, investors are looking for a very high rate of return, such as 50-60%, and CAPM cost of capital does not reflect much rate. What adjustments to be made to arrive at appropriate cost of capital? So for so VC method could also be used in this case when you are looking at pre-seed valuations and all. It's like company coming and looking at some particular valuation, right? You are expecting a return and ROI you will have. You can use a venture capital method here, because CAPM it becomes a little tricky because your rate of return is very high, and you might also consider not using CAPM to arrive. CAPM, it's not a mandate to use CAPM to arrive at your discounting factor. So from an investor perspective, when you are looking at a high rate of return, use that particular rate of return as your discounting factor. So that is much you are willing to pay. Again, I mean, highlighting this is not for statutory purposes. Assume an investor has come to you for valuing a pre-seed valuation company. That investor has an expectation of 50 to 60% return. That time, use that particular expected return for your valuation purposes. Okay, it's already 12, so let me wind it up here. There are a lot of other questions that's been coming up. So drop in a line maybe. I have shared my email ID, so your presentation or any questions you have, feel free to drop in a line. So Sunday, I don't want to, already 2 hours are over. I don't want to hold you more. I know most of you will be hungry. So, and thank you very much for giving me this opportunity. Yeah. Organizers, anyone there? Okay, someone has. Okay, someone is sharing the screen. Okay. Anyway, so let me stop the presentation here. So thank you everyone. So again, so I will drop in my email ID is rameez.raja@gmail.com. There are a lot of questions in the chat box which is left also. Feel free to drop in a line. Also presentation, please drop in a line. I can share the presentation. Yeah. Thank you everyone. Have a nice day. Have a great weekend. Stay safe.